Now speaking, Rich Kinder, Executive Chairman. Kinder Morgan's board of directors has successfully implemented orderly succession planning, with Steve Keen stepping down as CEO on August 1st and Kim Dang and Tom Martin taking over as president and president of the natural gas segment, respectively. The company is optimistic about the long-term future of Kinder Morgan, especially due to the role natural gas will play in the coming decades. U.S. natural gas demand is forecasted to grow by 20 BCF a day between 2023 and 2028, with 13.5 BCF a day of that growth coming from LNG and Mexico exports. This growth, combined with the strategic location of Kinder Morgan's network, will drive expansion and extension opportunities for the network and significant bottom-line growth. Now speaking, Steve Keen, Chief Executive Officer. Thank you. We had a successful quarter and year so far, beating our budget for the second quarter. Our outlook predicts slight underperformance on a full-year basis, which is explained by commodity prices coming in lower than our budget year to date. Our business is performing better, partially offsetting the lower commodity prices. We have a strong backlog of $3.75 billion, with $450 million of projects in service and $500 million of new projects added during the quarter. We have placed projects at attractive returns, well above our cost of capital. We brought the first of our Wabash Valley RNG projects into service on June 27, and we got a favorable outcome from the EPA on its June order, establishing the renewable volume obligation for the next 3 years. Our natural gas and terminals businesses are outperforming the plan, and our CO2 business is beating the plan on production, despite a significant outage in the first quarter. We are maintaining a strong balance sheet, originating new projects at attractive returns, and returning value to our shareholders through a well-covered dividend and opportunistic share repurchase. Now speaking, Kim Dang, President. In the quarterly earnings call, the company reported increased transport volumes of 5%, increased power demand of 6%, increased LDC demand of 6%, and increased industrial demand of 5%. Natural gas gathering volumes were up 19% in the quarter compared to the second quarter of last year, driven by Haynesville volumes, up 29%, Rockies volumes, up 26%, and Eagle Ford volumes, up 21%. Sequentially, gathering volumes were up 7%. Refined products were flat for the quarter versus the second quarter of last year, while road fuels were down 2%. Gasoline volumes were impacted by refinery maintenance during the quarter, and diesel volumes were down due to renewable diesel volumes in California being transported by other methods than pipelines. Jet fuel volumes increased 9%, and crude and condensate volumes were up 4%. In terminals, liquids lease capacity remains high at 94%, and utilization at key hubs, Houston Ship Channel and the New York Harbor, strengthened in the quarter. On the bulk side, overall volumes were flat, with increases in coal, fertilizer, and salt, offset by a reduction in grain. In the CO2 segment, lower prices on NGL and CO2 more than offset the increase in oil production, which was up 7%. For the year, the company expects net oil volumes to exceed their plan. Now speaking, David Michels, Chief Financial Officer. In the second quarter of 2023, we declared a dividend of $0.2825 per share, which is $1.13 annualized, up 2% from last year. We ended the quarter with a net debt to adjusted EBITDA of 4.1 times, leaving us with a good amount of capacity under our leverage target of around 4.5 times. We also had almost $500 million of cash at the end of the quarter and nothing drawn on our $4 billion revolving credit facility. We repurchased over $203 million worth of shares in the quarter, creating value for our shareholders. We were forecasting to be slightly below budget for the full year, mostly due to lower than budgeted commodity prices. Revenue was $3.5 billion, down $1.65 billion from the second quarter of 2022, and cost of sales were also down $1.7 billion. Net income was $586 million, down 8% from the second quarter of last year, and adjusted earnings was $540 million, down 13%. We generated cash flow from operations of $2.883 billion, paid out dividends of $1.265 billion, spent capital growth sustaining and contributions to our joint ventures of $1.18 billion, and made stock share repurchases of $317 million. Our adjusted EBITDA was $1.8 billion for the quarter, which was down 1% from last year, and DCF was $1.076 billion, down 9% from last year. Now speaking, Steve Keen, Chief Executive Officer. Thank you for the opportunity to present our quarterly earnings call. We are pleased to report that our company has had a successful quarter, with strong revenue growth and improved profitability. We have seen a significant increase in our customer base, with a record number of new customers signing up for our services. Our product offerings have been well received, and we have seen. UBS analyst Brian Reynolds inquired, what can we expect from the nat gas and terminal line segment in the second half of the year? Will outperformance continue or could we see a recovery in products? David Michel's replied, "Yeah, Brian, our natural gas assets have been performing well due to the volatility in the market. We've seen outperformance in our intrastate business, but our storage is full, so we may not be able to capitalize on that going into the end of the year. However, if prices and storage capacity become more available, we may have the opportunity to take advantage of that." Kim Dang replied, "We haven't seen the same level of outperformance in the second half of the year as we did in the first half, so we expect to be slightly down versus our original plan. However, if we see some of that outperformance in the back half of the year, it could improve our outlook." UBS analyst Brian Reynolds inquired, "Could you provide insight into the volatility of RIN pricing and how Kinder Morgan plans to utilize and monetize RINs on the balance sheet in the second half of 23? Steve Keen replied, "Yeah, so we anticipated the EPA's June announcement and increased renewable volume obligation, which was a 30% increase for the next 3 years. We held on to our stock and sold it at a higher price of 2.90 and above, rather than selling at 1.95. Anthony Ashley replied, "I believe the increase in RINs pricing is due to the lack of liquidity in the market earlier in the year. We have taken advantage of the uptick in pricing and have sold the majority of our inventory. We anticipate that RINs prices will remain steady for the remainder of the year." Tudor, Pickering, Holt & Company analyst Colton Bean inquired, "Steve, can you provide more detail on the $500 million added to the backlog? Are these projects mainly for 24 and 25? Steve Keen replied, "Yes, those were the two primary contributors to our growth this quarter. We saw an increase in our ER business and natural gas sector." David Michel's replied, "Our backlog is growing, with some of the orders coming in later than expected. This is adding to the overall length of our backlog." Tudor, Pickering, Holt & Company analyst Colton Bean inquired, "Anthony, what are the delays in the landfill RNG development and what are they attributed to?" Anthony Ashley replied, "Yes, we have seen delays on our 3 RNG projects this year. These have been due to supply chain, weather, and commissioning issues. Fortunately, our first facility, Twin Bridges, is now in service and we have a good line of sight for the other 2 projects." Barclays analyst Teresa Chen inquired, "What is your outlook for D3 RIN pricing over time and how do you take into account the supply of additional D3 RINs if an ARIN pathway becomes available?" Anthony Ashley replied, "Good question. We forecast our D3 RINs and sensitize our investments to a worst-case scenario. We also assume a portion of our RINs will be sold into the voluntary market, which is a fixed-price environment. The recent RVO targets, which were released for 3 consecutive years, are supportive of RINs prices with a 30% increase each year. We view ARINs as a long-term avenue for demand growth and pricing support, though it has been postponed for now." Barclays analyst Teresa Chen inquired, "What is driving the increase in EBITDA multiple for the remaining $2.6 billion in projects to 4.2 times from 3.9? David Michel's replied, "Teresa, the change in our backlog mix was due to the difference between the projects that went into service and those that were added. The projects that went into service had lower returns, while the projects added to the backlog had higher returns. This was the primary factor in the change." Wells Fargo securities analyst Michael Bloom inquired, "Can you explain the rationale behind excluding the CO2 and G&P projects from the backlog multiples and how this affects your approach to making investments in those areas?" Kim Dang replied, "No, Michael, our decision to exclude certain projects from our backlog does not affect our view of those projects. We believe the projects in natural gas, products, and terminals have a more consistent cash flow, which is why the sell side often uses the backlog to estimate EBITDA. However, CO2 and G&P projects can come on at a higher multiple, but then decline over time. We wanted to provide a better proxy for estimating the incremental and stably recurring cash flow. We still require a higher return on CO2 projects, typically 20% or higher, and G&P projects in the high teens. These returns are attractive and we will continue to pursue these projects." Wells Fargo securities analyst Michael Bloom inquired, "Could you please clarify the sustainability of the new run rate for Midcontinent Express and the amount of capacity that is now contracted and the duration of those contracts?" Sital Modi replied, "MEP has seen Oklahoma Basin drilling driving basis over the past couple of years, but we anticipate that basis will continue to strengthen as LNG facilities come online along the Louisiana Gulf Coast corridor and in southeast markets. We have been opportunistic in selling capacity to capture the highest margins and will continue to do so, waiting for the spread to widen in the 2 to 3 year tranche." Scotiabank analyst Tristan Richardson inquired, "What regional areas are seeing the most price sensitivity among smaller producers in your midstream operations?" Sital Modi replied, "Good question. Across the 3 basins, Haynesville producers have tapered off drilling plans due to the current pricing environment. However, larger producers anticipate LNG demand and Europe's potential volatility in the back half of the year, so they're keeping rigs up in the Bakken. We've seen growth in the Bakken and in the Eagle Ford. We're ahead of pre-COVID volumes even in this price environment. All systems are go." Scotiabank analyst Tristan Richardson inquired, what is the magnitude of the Markham project relative to your overall storage portfolio? Are third-party contracts involved, or is this new storage available to new customers? Sital Modi replied, yes, our Markham expansion is a 6 BCF addition to our facility. We've added 650,000 of withdrawal capacity and have already sold most of it at rates higher than we anticipated, providing us with better returns than expected. Wolf Research analyst Keith Stanley inquired, how is the company thinking about gas marketing to increase margins? Is it an opportunity to grow given the volatility of gas prices? Steve Keen replied, yes, we are expanding our gas marketing business, but we are doing so cautiously. We have been successful in enhancing our crude pipeline assets by utilizing capacity that would otherwise not be used and attracting additional volumes to the system. We are also doing well in our Texas intrastate business, where we buy and sell natural gas. We have storage and often find that we have excess storage that we can optimize and make money on. We have picked up additional bits of capacity around our system to expand this business, but we are doing so in a conservative and careful way. Wolf Research analyst Keith Stanley inquired, can you clarify what you mean by unbudgeted buybacks and how you think about buyback capacity for the rest of the year versus other priorities? David Michels replied, the comment was unbudgeted, meaning it wasn't part of our plan. David Michels replied, we take an opportunistic approach to share repurchases, meaning we don't have a programmatic approach. We'll use our balance sheet capacity to repurchase shares when the price makes sense. We want to take a balanced approach, taking advantage of good opportunities while preserving our strong balance sheet. Truist Securities analyst Neil Dingman inquired, what changes have you made to your budget for the remainder of the year and into 2024 due to lower than expected commodity prices? Kim Dang replied, yes, the forecast we provided today has gas and crude prices at the current forward curve. We have reset it for 2023 and will address 2024 during our budget process later in the year. Truist Securities analyst Neil Dingman inquired, what impact have lower recontracting rates had on the Eagle Ford crude and condensate business, and what can we expect for the remainder of the year? Dax Sanders replied, we have rolled one contract and we have about 84 to 85 daily capacity held by third parties. We have about 75 held by our intercompany marketing affiliate. These contracts have largely already rolled from the high legacy rates of 10 years ago and we don't expect any major changes in the next 2 to 3 years. Alliance Bernstein analyst Gene Salisbury inquired, can you explain the impact of the Copano roll-off on Eagle Ford gas volumes and has it been fully rolled off? Sital Modi replied, Gene, 2023 marked the end of the roll-offs. We have already completed our recontracting through 2023 and are now focusing on increasing our margins by increasing our volumes. Alliance Bernstein analyst Gene Salisbury inquired, do you agree that widening differentials in Texas and Louisiana gas could affect your next Permian gas takeaway solution? Sital Modi replied, I see a need to get infrastructure across to the eastern Louisiana side. We are exploring opportunities on our interstate networks to do this. We are having discussions with Gulf Coast LNG facilities and the Louisiana facility to support our next Permian project. All of this will be taken into consideration. Bank of America Merrill Lynch analyst Neil Mitra inquired, what impact do you anticipate the Rio Grande project having on GCX's expansion in the Corpus Christi area? Sital Modi replied, yes, congratulations to the Next Decade team for getting the project to the final investment decision, FID, stage. We have seen an increase in interest in the Permian project, as well as our Freer to Sinton project and GCX. However, the competitive environment means that returns will be the deciding factor in whether or not we move forward with the next project. Steve Keen replied, the Next Decade reference is not related to GCX. We have no connection to that project. The discussions have resumed and are active. Bank of America Merrill Lynch analyst Neil Mitra inquired, what contracts did you use to increase earnings despite the narrow basis between Waha and Henry Hub in the second quarter? Kim Dang replied, I want to clarify that the Texas intrastate market is typically locked in for 1 to 3 years. This means that the supply and demand on the other end is real and not affected by changing basis differentials. We have hedged back capacity between Waha and Houston, so we don't have much exposure to the basis differentials there. JP Morgan Chase & Company analyst Jeremy Tennant inquired, Steve, what is the leverage level that Kinder Morgan is targeting in the long term, and what is the path to achieving it? Are buybacks, acquisitions, or growth projects the primary drivers? What multiples are you seeing on new growth projects? Kim Dang replied, we're comfortable with our 4.5 times leverage target given the breadth and scope of our assets. We don't think it makes sense to bring it down, as it would cost a lot of money with no benefit to our cost of capital. We're currently running at 4.1 times, so we have flexibility to take advantage of opportunities. We're targeting 15% unlevered after-tax returns on projects, which can result in a going-in multiple of 7 to 8 times. We won't drop into single digits, but we'll still do the project even if it increases the backlog multiple. We're looking for projects to earn the maximum return, and our return threshold is BBB. JP Morgan Chase & Company analyst Jeremy Tennant inquired, what is Kinder Morgan's latest update on CCS potential? And what are Kinder Morgan's current thoughts on CCS projects in the Midwest and industry at large? Anthony Ashley replied, yes, we remain very active in the CCS space. We have a number of projects in West Texas, including the Red Cedar project, which is progressing well. Additionally, we are exploring opportunities in the Gulf Coast region for both transportation and sequestration of carbon dioxide. These projects have long development cycles, and we will provide updates when appropriate. Rich Kinder replied, we are actively evaluating opportunities to move and sequester our resources in the Gulf Coast. We have the expertise to do so, and if the returns are favorable, we will pursue these opportunities.